Welcome to our guide on common mistakes to avoid when investing in stocks. Whether you're a beginner or have some experience, understanding these pitfalls can help you make smarter decisions and protect your investments. In this video, we'll walk through the most frequent errors investors make, why they happen, and how you can steer clear of them. By the end, you'll be equipped with practical tips to navigate the stock market with greater confidence and avoid unnecessary losses. Let's start by exploring why so many people fall into these traps and how awareness is the first step toward successful investing. One of the most common mistakes investors make is jumping into stock purchases without doing enough research. It's easy to get caught up in hype or follow a friend's advice, but investing blindly can lead to poor choices. Before buying any stock, it's important to understand the company's business model, financial health, and future prospects. Take time to read annual reports, study industry trends, and analyze recent news. This groundwork helps you make informed decisions and reduces the risk of unpleasant surprises down the road. Emotions can be a powerful force in investing, often leading to impulsive decisions. Many investors buy stocks out of excitement or fear, rather than relying on logic and analysis. For example, panic selling during a market downturn or chasing a hot stock because everyone else is buying can result in significant losses. It's crucial to keep emotions in check and stick to your investment plan. Developing discipline and patience will help you avoid knee-jerk reactions and stay focused on your long-term goals. Trying to perfectly time the market is a mistake even seasoned investors make. The idea of buying low and selling high sounds simple, but predicting market movements is extremely challenging. Many people end up missing out on gains or selling at a loss because they wait for the perfect moment. Instead, focus on a consistent investment strategy such as dollar cost averaging, which reduces the impact of short-term volatility and helps you build wealth steadily over time. Putting all your money into a single stock or sector is a risky move. Diversification is a key principle in investing because it helps spread risk across different assets. If one investment performs poorly, others may do well and balance out your portfolio. By owning a mix of stocks from various industries and regions, you can reduce the impact of any single company's downturn and increase your chances of steady return. Every investment carries some level of risk, but failing to assess and understand those risks can lead to trouble. Some investors focus only on potential rewards and overlook the possibility of losses. It's important to evaluate your risk tolerance and consider how much you're willing to lose before investing. This self-awareness will guide your choices and help you avoid taking on more risk than you can handle. Frequent buying and selling of stocks, known as overtrading, can eat into your profits through transaction fees and taxes. Some investors believe that constant activity will lead to better returns, but in reality it often results in lower gains and higher costs. A disciplined, long-term approach is usually more effective. Focus on quality investments and give them time to grow, rather than chasing short-term trends. The investors overlook the impact of fees and taxes on their returns. Brokerage commissions, management fees, and capital gains taxes can significantly reduce your profits over time. It's important to understand all the costs associated with your investments and factor them into your decision-making process. Choosing low-cost investment options and being mindful of tax implications can help you keep more of your hard-earned money. It's tempting to act on stock tips from friends, social media, or news headlines. However, chasing hot tips without verifying the information can lead to poor investment choices. Always do your own research and make decisions based on facts, not rumors or hype. Remember, if something sounds too good to be true, it probably is. Investing in trendy stocks or sectors just because they're popular can be risky. Fads often fade quickly and prices can drop just as fast as they rise. Instead of following the crowd, focus on companies with solid fundamentals and long-term growth potential. This approach will help you avoid the ups and downs of market fads and build a more stable portfolio. Investing without clear financial goals can lead to confusion and poor decisions. Before you start, define what you want to achieve, whether it's saving for retirement, buying a home, or funding education. Setting specific, measurable goals will help you choose the right investments and stay motivated, even when the market gets tough. Your investment horizon, the length of time you plan to hold your investments, should guide your choices. Short-term needs require different strategies than long-term goals. Ignoring your time frame can lead to mismatched investments and unnecessary risk. Always match your investment strategy to your timeline for the best results. Believing you can consistently beat the market is a common trap. Overconfidence can lead to risky bets and ignoring warning signs. Even experienced investors make mistakes, so it's important to stay humble and open to learning. Regularly review your performance and be willing to adjust your strategy when needed. While it's important not to chase every trend, completely ignoring market trends can also be a mistake. Understanding broader economic and industry trends can help you make better investment decisions. Stay informed about what's happening in the market, but always filter information through your own research and investment plan. Failing to regularly review your portfolio can result in missed opportunities or increased risk. Markets and personal circumstances change, so it's important to check your investments periodically. Rebalancing your portfolio ensures it stays aligned with your goals and risk tolerance, helping you stay on track for long-term success. Investing without an emergency fund can put you in a tough spot if unexpected expenses arise. Before putting money into stocks, make sure you have enough cash set aside for emergencies. This safety net allows you to invest with confidence, knowing you won't be forced to sell investments at a loss if you need quick cash. Some investors forget to account for inflation, which can erode the value of your returns over time. It's important to choose investments that have the potential to outpace inflation, such as stocks or inflation-protected securities. Keeping inflation in mind helps you preserve your purchasing power and achieve your financial goals. Investing in companies or products you don't fully understand can lead to surprises. Make sure you know how a business makes money, its competitive advantages, and the risks it faces. The more you understand your investments, the better equipped you'll be to make smart decisions and avoid costly mistakes. While it's important to do your own research, ignoring professional advice can be a mistake. Financial advisors can offer valuable insights and help you create a plan tailored to your needs. Don't hesitate to seek guidance, especially if you're unsure about complex investment decisions. Using borrowed money to invest, known as leverage, can amplify both gains and losses. Many investors underestimate the risks and costs involved, such as interest payments and margin calls. Make sure you fully understand how leverage works and the potential downsides before using it in your investment strategy. Chasing high returns without considering risk can lead to trouble. It's important to balance your desire for growth with your ability to handle losses. A well-rounded investment plan considers both potential rewards and risks, helping you achieve your goals without taking on more risk than you can tolerate. Dividends can be a powerful tool for growing your wealth, but some investors overlook the benefits of reinvesting them. By automatically reinvesting dividends, you can take advantage of compounding and accelerate your portfolio's growth over time. Check if your brokerage offers a dividend reinvestment plan and consider enrolling to maximize your returns. Asset allocation, how you divide your investments among different asset classes, is a key factor in your portfolio's performance. Ignoring asset allocation can lead to unnecessary risk or missed opportunities. Review your allocation regularly and adjust as needed to stay aligned with your goals and risk tolerance. Everyone makes mistakes when investing, but failing to learn from them can be costly. Take time to review your past decisions, identify what went wrong, and adjust your strategy accordingly. Continuous learning is key to becoming a better investor and avoiding repeated errors. Scams and fraudulent schemes are unfortunately common in the investment world. Be wary of promises of guaranteed returns or pressure to act quickly. Always verify the legitimacy of any investment opportunity and avoid deals that seem too good to be true. Protecting yourself from scams is an essential part of successful investing. Keeping accurate records of your investments is crucial for tracking performance, filing taxes, and making informed decisions. Some investors neglect this step and end up with confusion or missed opportunities. Use spreadsheets or investment tracking tools to stay organized and up to date. Focusing only on domestic stocks can limit your growth potential. Global markets offer a wide range of opportunities and can help diversify your portfolio. Consider adding international stocks or funds to your investment mix for broader exposure and potentially higher returns. Stock prices can fluctuate widely in the short term, a phenomenon known as volatility. Some investors panic during market swings and make rash decisions. Understanding that volatility is a normal part of investing can help you stay calm and stick to your plan, even when prices move sharply. Dollar-cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This strategy helps reduce the impact of volatility and removes the pressure of trying to time the market. Ignoring this approach can lead to missed opportunities and increased risk. A stop-loss order automatically sells a stock when it reaches a certain price, helping you limit losses. Some investors neglect to use this tool and end up holding onto losing positions for too long. Setting stop-loss orders can help you manage risk and protect your portfolio from major downturns. Markets and personal circumstances change over time, so it's important to review your investment strategy regularly. Sticking to an outdated plan can lead to missed opportunities or increased risk. Make adjustments as needed to stay aligned with your goals and the current market environment. Behavioral biases, such as confirmation bias or loss aversion, can cloud your judgment and lead to poor investment decisions. Being aware of these biases and actively working to counter them can help you make more rational choices and improve your investment outcomes. Liquidity refers to how easily you can buy or sell an investment without affecting its price. Some investors overlook liquidity and end up stuck with assets they can't sell quickly. Always consider how easily you can access your money before making an investment. Over time, your portfolio's allocation can drift away from your original plan due to market movements. Regular rebalancing brings your investments back in line with your goals and risk tolerance. Ignoring this step can lead to unintended risk and missed opportunities for growth. Tax-advantaged accounts such as IRAs or 401(k)s can help you grow your investments more efficiently by reducing your tax burden. Some investors overlook these options and miss out on valuable tax savings. Make sure to explore all available account types to maximize your returns. Compounding is the process where your investment earnings generate their own earnings over time. Some investors underestimate its power and focus only on short-term gains. By staying invested and reinvesting your returns, you can harness compounding to build significant wealth in the long run. Expecting to get rich quickly from stocks is unrealistic and can lead to disappointment. The stock market rewards patience and discipline, not get-rich-quick schemes. Set realistic expectations for your returns and focus on steady long-term growth rather than chasing quick profits. Investing while carrying high-interest debt can undermine your financial progress. The returns from stocks may not outweigh the cost of debt, especially credit cards or personal loans. Pay down high-interest debt before investing to ensure your money is working for you, not against you. Major life events such as marriage, having children, or changing jobs can affect your financial goals and risk tolerance. Failing to adjust your investment plan after significant changes can lead to mismatched strategies. Review your investments regularly and update your plan as your life evolves. Estate planning ensures your assets are distributed according to your wishes and can help minimize taxes for your heirs. Some investors neglect this important step, leaving their loved ones with unnecessary complications. Work with a professional to create an estate plan that fits your needs and protects your legacy. Investing in foreign stocks introduces currency risk, as exchange rates can affect your returns. Some investors overlook this factor and are surprised by unexpected gains or losses. Be aware of currency fluctuations and consider hedging strategies if you have significant international exposure. Holding some cash in your portfolio provides flexibility and security. It allows you to take advantage of new opportunities or cover unexpected expenses without selling investments at a loss. Don't overlook the importance of cash as part of a balanced investment plan. There are many types of investment products, from stocks and bonds to mutual funds and ETFs. Not understanding how these products work can lead to confusion and mistakes. Take time to learn about the features, risks, and costs of each product before investing. Patience is a key ingredient for investment success. The stock market can be unpredictable in the short term, but over time, disciplined investors are often rewarded. Avoid the temptation to make frequent changes or react to every market movement. Stay patient and let your investments grow. I've covered a wide range of common mistakes investors make and how to avoid them. By staying informed, setting clear goals, and maintaining discipline, you can navigate the stock market more confidently. Remember, successful investing is a journey, not a sprint. Keep learning, stay patient, and make decisions based on careful research and planning. With these principles in mind, you'll be well on your way to building a strong financial future.